SMB Investor with Nick Bryant and Sean Smith.
Hey everyone, you got Sean Smith here, managing partner at Search Fund Ventures, and today I'm joined by Lisa Forrest. Lisa and her team at Live Oak Bank are one of the most prolific lenders in the SBA space, and she's going to teach us all about how searchers use SBA loans to finance their deals and how investors should think about sitting in a cap table alongside a preferred lender like Live Oak. So, Lisa, thanks so much for joining.
Yeah, thanks for having me, Sean. Really appreciate it.
So why don't we start by kind of going through a background of your career, your group at Live Oak, and kind of sharing just the high level on what you guys do day to day.
You got it. So this is my 38th year of banking, of which I have focused in the lower middle market my entire career. I've been in the lower middle market when it wasn't even fancy and it was not called an asset class. I've just been doing business acquisition, pure and simple, on a real simple level for my entire career. And now we have a lot of momentum around it, and now even investors in the space. When I started in my SBA career, the idea of having investors in the cap table was something that was set aside for middle market and really large transactions. So the fact that investors can have part in it, play a little bit of a part in an SBA type transaction, that's fairly new on the scene. I'd say really even momentum around investors is really kind of a 3-year phenomenon. It's been happening a lot longer than that, but just all the momentum around it with all the podcasts, right? All the social media, all of the awareness and the education around that, that's really been gaining a lot of momentum in the last, I'd say, really 3 years, even though we've been doing it for a lot longer than that. So I've worked at large banks. I've worked at small community banks. I've worked at startups. I've worked at companies that have been the largest SBA lender. This is my third largest SBA lender that I've worked at. So I have a real breadth of big, small, and in between. Personally, for me, I favor the growing banks that are breaking ground and creating new ways of lending in a very sane and safe way, but coming at the market maybe in a little bit different way. So I head up our self-funded search team at Live Oak Bank, and we focus on what now has its own name, self-funded searchers. Again, when I started doing this, it used to just be called business acquisition, but now it's self-funded search. And that's my main goal for coaching and mentoring in this niche.
That's great. You know, it's hit the mainstream when it's got its own kind of vernacular around it, right?
Right.
That's the indicator. And what kind of, what made you guys decide to create this self-funded search group? And really, when did that terminology, or when did you start kind of seeing that specific subsegment become a focus for preferred lenders?
Yeah. So I'm going to say about 10 years ago, I was working at Wells Fargo at the time, and I noticed there was a little bit of a shift starting with buyer profile, where the SBA loan program for many, many years, decades, kind of favored maybe an acquirer in their 50s coming out of corporate America, maybe husband and wife buying a company. They have had a tendency to be smaller. And about 10 years ago, I really noticed a big shift toward individual buyers on the younger side of the spectrum coming in with their own cash, yes, but then the conversation started, and I've got some investors backing me. And at first I was like, "Oh, well, that's interesting. Tell me more about that." And then realized that there were schools at that time, was mostly HBS, Harvard Business School in Chicago Booth. Stanford, yes, teaching ETA, but they're traditionally funded doing conventional lending. But notice that there were schools that were teaching entrepreneurship through acquisition as an actual class, and actually trying to lay a groundwork for the next generation of entrepreneur, actually putting a methodology around it, putting tools and resources in the hands of the next entrepreneur. And that was a big shift. People in my generation really kind of didn't go down the entrepreneurship path. We all went into corporate America. And then the next generation after that is reviving the next generation of entrepreneur idea. And the fact that business schools were taking that on and promoting it, and helping folks consider that as a path versus maybe sort of the W-2 or consulting or what path an MBA might go to. And I noticed also that that it's not all just sort of 20-year-olds maybe coming out of business schools, but something that now also has a term called mid-career searcher. Also just used to be called business acquirer, but now mid-career searcher, maybe having 10, 15 years, maybe even 20 years of work experience, going back, getting their MBA, taking this idea on and going all in, and then coming out of their, with their MBAs and now trying to acquire companies. And they might be in their, late 30s, 40s, and gosh forbid, even 50s, even 50-year-olds can still be buying companies, right? But the age has been trending toward the younger end of the scale. And at the time I came over to Live Oak Bank in 2017 with my then partner, Heather Anderson, we brought this kind of concept to Live Oak Bank at that time. And I've been doing it here since 2017.
Very neat. Well, that's a great story. And it seems, not only kind of in the traditional business school world, but clearly from what you're seeing as well, that this form of entrepreneurship is just ballooning in popularity, right? I mean, you've got your Stanford study talking about all-time highs for traditional search funds raised, and I think the trend, at least in the SBA and A volumes that we're seeing, a lot of which is most likely for acquisitions, right? That's been also trending upwards, almost defying gravity given the fact that interest rates are pretty high, right? So probably also an indicator to some degree of this growth in acquisition entrepreneurship.
Absolutely. And I would say, though, on the topic of interest rates, I've been doing this long enough, though, where the interest rates are today, they're not considered high to me. They're considered on average, where interest rates might sort of ebb and flow over the years, especially if you've been in lending and just in business for 30 plus years. This, on the grand scheme of things, might not necessarily be considered a high interest rate. I know where a lot of people in the space, where they entered at the phase of where interest rates were, and that might be someone's entry point into what these are, what interest rates are. And then so in comparison to where we are now, might be considered high, but over a really long average, they might actually be considered a little more stabilized.
That's a great point, and we should come back to that in a bit. I want to just quickly, before we kind of get into some of the more tactical items like that, if you can give a sense for folks that are less familiar with how capital structures in small business acquisitions are composed, help us kind of understand where the SBA loan sits in terms of preference, how folks use SBA loans to buy businesses, and what that kind of general mix of capital structure looks like. And I know there's regulations around it too that might be worth mentioning.
Yeah, you bet. And when we say self-funded search, just because it seems like you have a wide audience coming to your podcast from an investment or investor standpoint, when I'm talking self-funded search, I just mean we've got someone maybe part-time or full-time, and they're paying for their search. The search of looking for a company, doing diligence on that company, that is in a large part coming out of their own pocket. They are self-funding their search. There are more variations on the theme now, where you can actually have sort of accelerators or investor entities that are actually now starting to help self-funded searchers actually pay for their search. And so I don't know what we would call that then, but I guess just SBA acquisition. But so the SBA loan, it is designed to be kind of a highly leveraged transaction. And that is because the SBA, the U.S. Small Business Administration, is guaranteeing a part of the lender's loan. And they're guaranteeing, for a business acquisition in the SNA program, they're guaranteeing 75% of the borrower's loan. So the U.S. Small Business Administration, using Live Oak as an example, is going to guarantee 75% of the loan I'm giving to the borrower. That means the lender's on the hook for 25% of that. If something goes wrong, something goes bad, and we have to go back to the SBA and actually ask them to honor their guarantee, the lender is still on the hook for 25% of that. And then we're also taking a personal guarantee from the borrower and anyone who owns 20% or more of the borrowing entity. So from the standpoint of the investors on the tuning in here, don't get too excited, because you have to keep your ownership percentage in a certain proportion. 20% or more is going to have to personally guarantee. So most investors are going to want to stay under that level.
Yeah, that's a really important point. We talk about that, I believe, on a prior series episode that we had, where there's this kind of strategy of investing in self-funded searchers is in effect artificially constrained because you can't own more personally, you can't own more than 20% of any given deal you do. So it's a great point. And just in terms of kind of, when you compare the SBA sort of program, an SBA loan with a more conventional loan, what are kind of some of the key differences that you?
So the benefits of that personal guarantee is really what we're talking about. And the thing that SBA does for you is that it helps you afford sort of more transaction than you otherwise could with a conventional loan because it's highly leveraged. It's meant to be a high leverage vehicle. So here's some of the things to think about. You get a 10-year term, fully amortizing, no balloons, and the SBA requires a minimum of 10% down. So typically, just from an industry standard perspective, the cap stack looks like this: 10 to 15% down from the borrower. And that could include some amount of investor uh, contribution, kind of bridging the gap between what the borrower might have, operator, guarantor might have, and sort of that deal size. So 10 to 15% down, then generally a 10 to 15% seller note. That's been sort of industry standard for years. And then the SBA lender is typically doing 75 to 80% financing. So if the client is putting 10% down in, you're technically getting 90% financing between the SBA loan and the seller note. And to some people tuning into your podcast, that might sound absolutely crazy that you're getting 90% financing to acquire a company. Again, the SBA is kind of compelling lenders to maybe make cash flow loans because also there's not a collateral loan to value goal here. If our guarantor operator has collateral or has equity in their home, we will take a lien on the home, but we're not necessarily looking for a certain loan to value. It's all cash flow coverage based. And at 90% financing, the 10-year term is the thing that's helping you kind of make all that work.
Right. Well, and that's a great segue into kind of talking a bit about your underwriting process. So, if cash flow is such a core piece of the underwriting, that is kind of the element of the business that you're underwriting to, you need to make sure that that cash flow is going to be there to support the loan payments, right? So, why don't you tell us a bit about how you guys look at a business, and evaluate a buyer to get comfortable, not only that the financial profile that the buyer is delivering through quality of earnings or through whatever that they deliver has been true historically, but that it's going to remain that way going forward. So we'd love to
Yeah, absolutely.
hear how you guys do it.
You bet. And I'll kind of compare and contrast maybe our point of view with other lenders' points of view as well, just to give your audience a sense of sort of the breadth of sort of the ranges of how
Yeah,
this might work.
that's great.
So for Live Oak, for Live Oak, if we're doing something industry agnostic, and what I mean by industry agnostic for us, one of the interesting things about Live Oak is that we have 40 different verticals at Live Oak. So we have a vertical around HVAC and plumbing. We have a vertical around home health. We have a vertical around pharmacy, bookkeeping. We have 40 different verticals. So to us, those aren't industry agnostic because we know something about those industries because we've been doing, hundreds of those. So if we are industry agnostic though, and there's so much, those are 40 industries we have put, a vertical head around. As you know, so much more industry out there that happens in this kind of quirky lower middle market, all the stuff that sellers do to really make a really good living. So if it's industry agnostic, we want to be at a 1.5 debt service coverage or higher. So what that is, just the math on that is adjusted EBITDA over total annual debt payments for our loan, SBA loan, and the seller note, and then interest only on your line of credit. We want adjusted EBITDA cover at 1.5 times or better. If it is in one of our verticals, we might be okay at a 1.25 or a 1.30. It's pretty skinny margins on how SBA loans typically have been conducted over all these decades. And there are some lenders that, regardless of the industry, kind of an industry standard is a 1.25 debt service coverage. So when I say these are sort of designed to be highly leveraged, I mean those are the coverages where most loans are getting done. Now, having said that, that's kind of quantitative and a little more quantitative, and then I'll throw out some qualitative stuff. In order for the debt service to pencil, I had mentioned 10 to 15% down. I'd say in about 50% of our transactions we're doing now, the buy side is coming in with well more than 10 to 15% equity, just because of where multiples are in lower middle market. It is still, in my observation, a seller's market. So we're not talking 3 to 4 times multiple. In a lot of cases, we're talking 4.5, 5, maybe even 6 times multiple. And if that's the case, then you're typically coming in with more than 10% down to make that guardrail debt service work.
Yeah, that's exactly what we're seeing too. I think unless the deal is, below that 4.5 times or so mark, kind of really below that 4 times mark, it's hard to get those, absurdly high levels of debt to capital. And when we talk about, financial leverage, meaning a debt to EBITDA ratio, which I think is probably a more popular covenant for conventional lenders in many cases. Those people typically try to keep those below 3.5 times or so. I don't know. Do you guys have generally a benchmark around that kind of debt to EBITDA ratio, or is that less of a focus?
It's not how SBA tracks. That is absolutely conventional. And where in our cap stack to compare to conventional, where we're doing sort of that, almost 80 to 90% financing all in with that seller note. Conventional, the cap stack might be more like 40% or 50% total debt. So it's just a much different quantum. And the other thing to mention is SBA loans have one covenant, and that's around the seller note. So we don't have debt to EBITDA covenants. We don't have fixed charge covenants. We don't have current ratio covenants. And that's another thing where sometimes the investors say, oh, wow, I could really do a lot with that. But, again, you got the personal guarantee at 20% or more. Caution my acquirers, because these are generally, even though they might have some investors in their cap table bridging equity gap, we're basing our decision on the guarantor, their operational ability. And if you don't have covenants, then it's a long leash. So as long as everything's going well, you are in charge of all of that. If things start to slip or slide, there's not a lot of fallback. And so sometimes not having a covenant, not having a little bit of accountability with reporting to your lender, that can also go sideways on you pretty quickly. So not having covenants might sound really interesting. In practical matters, it can be a pretty lonely, enterprise for you.
Yeah, I mean, accountability can be critical. Go ahead. Sorry.
No. I was just going to say, so the one covenant we're allowed to have in SBA is around the seller note. So we're allowed to put a metric in that if your debt service post-close falls below a certain metric, we could, as the bank, have a little bit more heavy hand to, put a pause on those seller note payments. So that's the one covenant we're allowed to have.
Got it. And I assume, generally speaking, that means seller note documents need to be sort of drafted with the ability to, forego some of those payments if the bank decides to, bring that heavy hand to play. Is that right?
Yeah, absolutely. The sellers will sign a subordination that's with the SBA and the lender that so notes they're behind us. And in the language is also, and you recognize and acknowledge that if the business post close isn't going well, that you acknowledge that we could have something to say about that.
Right. Very helpful. So, you know, speaking of deals that maybe haven't gone as well, what are kind of the key considerations that, in your 38 years of doing this, you've learned consistently indicate that maybe it passes the debt service covenant test and, or the debt service ratio, and it passes the seller note covenant, but there's some other items in there that may cause you to say it's not going to be a fit for us. And I know right off the bat, we've talked about some deals that are more kind of project based or construction oriented that are probably a bit challenging just because of swings in cash flow. So what are kind of maybe some other non-papered items like that might be worth mentioning?
That's great. And starting with that project-based work, that's a big one, especially in the context of SBA, because these are meant to be more highly leveraged, lower debt service coverage margins, and there's usually not a lot of extra cash available or typically these aren't being over equitized. So in an SBA context or in a conventional context, when you're only putting 40% debt on something, the investors or that operator might feel okay taking more risk. These are the things that in an SBA context makes us really nervous, and people really need to pay attention. So you had project-based work and flows and inconsistencies in performance from year to year. For us on new construction, new build, anything that is higher than 20% new build or new construction, that's typically probably going to be a pass for us. So we're doing repair and maintenance. As I mentioned, we have an HVAC and plumbing vertical. We like that very well, assuming it's repair, maintenance, renovation, not HVAC systems going into new developments or something. And that kind of new build goes across lots of different kinds of industries. We'll even look at new build if it is, say it's manufacturing that are making pipes or hoses. Our question is, well, who's the customer? Oh, we sell to contractors. Okay. Manufacturing, great, we like it, but not in that context. Another big one, customer concentration, especially in this lower middle market where the deals are skinnier compared to probably what a lot of your investors are investing in. Customer concentration is, I think, probably the biggest thing that we see that can really cause you to have some problems pretty quickly. We'll do a downside analysis on any customer that's 20% or more. And if it's priced correctly and the margins are such that you could lose that customer and still pay yourself and pay us, probably not paying the seller, then that's something we might look at. But typically, because of where the multiples are in lower middle market, if you've got a customer that's anything above 20%, you lose that customer, it's going to create some big issues. Another thing we see a lot in lower middle market land for SBA is seller dependency, especially in the smaller transactions where the seller is the key salesperson. They might be the estimator, and they might even be running a machine too, and they have 2 other employees. We see that a lot. Even if you have industry experience, that one's probably an uphill battle, but seller dependency is a big one. Supplier dependency, especially with everything going on with supply chain and potentially tariffs.
Yep.
Supplier dependency will be one that we'll dig into. Seasonality, we see in certain industries where they get all of their revenue from November to January, or they get all their revenue from May to July. Those are probably going to be a tough battle. We don't have a lot of structuring. We don't have as many levers to pull on structuring wise like you might in a conventional loan. So it's not like we can put a pause on our loan for 9 months out of the year. So it's really, and you probably can't pull enough working capital in to make that work. So seasonality is a big one for us. Cyclicality is another one. Oil and gas, like we're not doing oil and gas. New build, obviously cyclical. Ties to mortgage lending, and that's a cyclical potential regardless of where interest rates are. So mortgage lending, that's something that we're not looking at. I can rattle off some more. Do you want to ask me some questions? I don't mean this to be a lecture, but I've got like 10 more.
Well, these are great. So it's funny because I was speaking to another investor once, and I was kind of rattling off some of the items we look at, and they said, okay, so you basically go through the lender checklist. And I said, yeah, we're an equity investor, and we definitely pay close attention to the lender checklist as well. So I'd say, yeah, if you've got 3 more that you want, the top 3 that I would love to hear them.
And I say that we're really well aligned on most parts between equity and debt. I've got a few places that maybe we could talk about where I think we diverge, where you're concerned about some things that we might not be. I would also say culture, and this one's so hard to diligence, but can you see yourself working there? Like you do a site visit, you're there. If it's an office job and you're used to kind of being more hands-on, or it's a very hands-on job and you come from white collar, could you literally see yourself doing that job, being there? And if someone doesn't show up to work that day, which happens a lot, how would you manage that? How could you manage that? So just the culture around what the sort of the vibe of the office feels like, could you literally see yourself there? And I know it's a hard one to diligence, but we've had people that have decided not to move forward with a deal when they actually realized that that's what the job was. And I would also,
Well, just to touch on that one, we were in a board meeting recently, and to double down on how hard that stuff is to find until after the deal closes. At this specific company, there's two branches, and at one of the branches, the kind of culture, it all trickles down from the head, right? So the leader of that branch did not kind of audit people's time for the kind of folks on the ground, and that became the culture there for folks to go say they were out on the road doing their routes and kind of being productive, but they'd come back and very little would actually get done. The other branch was the polar opposite. It's tech enabled. Everyone's got a tablet. Everyone's kind of tracking their time and their work as they go. And it was incredible to see that they were virtually two different operations, but under the same business. So the first thing that these searchers did when they got in was promote the person who's leading that one branch and try to instill that culture in the other. And obviously that's challenging, but it's really hard to identify that stuff prior to close. And as a lender, I'm sure you want to make sure that, I guess, 90% of the time you're getting the culture that I described, with the tablets and with the productivity, versus the folks that aren't really generating cash, probably not collecting cash to pay the loans, all that good stuff.
Well, and that's the thing too. You're in transition and you realize that the cash collection is not what you thought it was, and then how do you actually turn that around? How do you actually instill a new process into a company you just acquired in this lower middle market? You might have $600,000 of EBITDA, not a lot to really play with, but it's a great point. So that idea of the culture and doing your best to key in on some of that stuff, but then also if you get the culture wrong, being the person that can hang in there and figure out how to put it in the move it in the right direction.
Right.
That's a tough one.
Yep.
I would say the other thing is kind of industry experience, transferable experiences, and then if you also then have to relocate on top of that, where you're coming into a totally different industry, you might have something that we're saying is transferable and you're relocating. And then you have to kind of understand the industry and understand the community in which you now live. So that one's kind of, I'm through 3 or 4 bullet points into just that idea of transferability with relocation, because we
Yeah.
see relocation a lot. And it can be a little dicey, especially if the seller really had relationships and that's how they were, getting the revenue in the door was their relationship. And now you're in a new community and having to learn those relationships.
Yeah.
Anyway, I've got like 10 more, but of course I'm the lender. I could come up with a million things that I don't like. So
Well, you can, when you do your next office hours, we'll have to get folks on there so you can keep kind of giving all the checklist items.
makes
There
it sound like
was,
we're not making any loans, but we are.
yeah. Yeah. Is there anything that actually fits all those criteria? But no, that's really helpful. I think it would be great to just end off this piece of, the conversation with where you see, your criteria diverging from equity investors' criteria.
I think we're both sides, the debt and the equity, the capital is looking at all of those things. I really do. The difference that I see is that we are looking at the financeability and the decision making on a historic performance basis. So I'm looking at the historic EBITDA. I'm looking at what the company has done as is. We are providing debt that can hopefully be afforded today based on the company today. Our acquirers come in and hopefully do no harm. Hopefully they actually bought the company that they thought they bought and they have a period of time to transition orderly. I am not asking so much about their investment thesis. I am. I want to know what the projections look like, and I want to make sure working capital is aligned with, a little bit of that growth strategy. But if truly, if the if our borrower paid us back as agreed for the 10 years of the loan and they didn't grow the company, that'd still be a win in my mind. But for investors coming in, you're also looking at growth opportunity and growth potential and how you're going to, allocate your capital here or there. And you're going to key in a little bit more on the investment thesis and the growth and the scalability and all those sorts of things. We do that to some extent because I want to know the whole story, absolutely get to know my client and what they're planning to do with the company. But growing the company is not one of my requirements. Paying the loan back is the requirement. So I think that's a little bit where you're going to get into some different types of conversations with your prospective folks that you might be bringing some equity into the cap table on.
Yeah, it's a great point, right? I mean, at the end of the day, to your point, growth doesn't really matter much to you because it doesn't change the outcome, right, for the lender in a sense. What matters much more is that, the earnings don't shrink to a point where, the working capital isn't so thin that payments start getting missed, right? That's really what you guys need to focus on.
Absolutely.
So that's great feedback. And maybe can you, this has been really helpful information on kind of just empirically, how to look at self-funded search deals from the lender perspective. Can you just help us understand a little bit more about how many of these deals you guys are typically seeing per year? What percent of them, if you know it, just ballpark, have kind of third-party equity investors involved? Because our sense is a lot of them go, funded by the individual or potentially by friends and family. But you're so close to the market, would love to get your pulse on any of that information if you have it.
And I think I'm going to be skewed in my answer because I am putting myself in a position where I'm doing the kinds of deals where they might benefit from some gap equity, and that's something we're supporting. So this is my day job to work in this environment. So I think I'm going to be skewed on the high end of, I'll say 80% of our transactions have some amount of investor equity in them. I haven't actually counted them up. I'm just kind of going off my gut there. If you look at the SBA ecosystem, just SBA lending, I think that would skew high. There's a lot of SBA acquisition lending getting done with just buyer equity or more friends and family. There's a lot of that still happens, but my day job is to actually put myself in this environment when we're talking about equity investors. So we look at part of our kind of value proposition at Live Oak anyway is that Sarah, my colleague Sarah Andrews, and we will look at searchers deals pre-LOI. So we will look at probably anywhere 350, maybe even 400 deals pre-LOI.
That's per year?
Uh-huh.
Wow, that's great.
Yeah, it's a lot. The percentage of the deals that we actually decide to put financing behind is, maybe 10% of that.
Still great.
So,
So, 30 to 40 deals, 50 deals a year.
yeah, right. And then that's just us, right? So it's all about lender fit. It's all about investor fit too. So you could see a deal that just isn't a fit for you, could be in an industry that isn't kind of a good risk for you, and another lender could be doing it. So of those loans that we pass on, some are just definitely not financeable. But some could be, hey, we've decided that customer concentration is just too high for us and they're getting done elsewhere. So I don't know what percentage of the ones we pass on ultimately get done. And again, we look at probably 3 or 4 deals for a searcher before they find the right LOI. So some of those are sort of test runs and they're getting their legs underneath them on how to actually analyze a deal. So a lot of that we look at to be more coaches and mentors, really.
That's such a great thing to do. I mean, for so many folks, the first LOI they put out, I think a lot of searchers, if you ask them, about the first LOI they put out, they'd say, man, I would have done that a lot differently. Right. So to have you guys helping kind of coach them through each step of the way and to be able to come back around when they get new deals on the table, that's such a great approach and kind of way to mentor folks. I think just a transition, since you see so many of these deals, would love to hear some stories that you have. At 50 or so deals a year, you've got to have some really good anecdotes for folks.
Yeah. Yeah. And I think one of the things that isn't talked about in SBA at all, not enough, if at all, where you talk about this more on the conventional side is the J curve. Where I think in conventional lending, you actually underwrite to that J curve, where in SBA lenders really aren't underwriting to the J curve. It's one thing, we're gonna adjust EBITDA for maintenance CapEx, of course. We're going to adjust for CapEx. We're going to adjust for, rent increases going forward, and we're going to make some of those adjustments. But we aren't necessarily underwriting for an oops, or we're not underwriting if they ultimately are going to be hiring a new salesperson. Unless they're doing it right away, unless we know it's part of their strategy right away,
Right.
we're going to adjust for new salaries. But
Sure.
the sort of the just organic growth that they're contemplating, there's going to be a J curve, and we're
Yeah.
not necessarily
The
underwriting for
growing
that.
pains. Right.
Yeah, like growing pains. We don't necessarily underwrite for that. And we just really hope that the transition goes well. Places where we have heard where transition hasn't gone well, these are live examples. There's they're currently paying us as agreed, by the way. So I'm going to give you examples where they've
That's
worked it out. In fencing, by the way. So I got a fencing example where it turned out that this particular business, their business was coming in more from home resales, where a new owner comes in, wants to replace the fence, versus what the searcher thought it was just more general repair and maintenance of the fence. And it was turning out to be that it is actually when they buy a new home, they come in and then they replace the fence. So that project-based work was just a lot more pronounced, even though at the end of the day, it looked like the revenues and performance was pretty consistent, but within that revenue, it was really lumpy. So diligencing that kind of project-based work, that was a miss here. And then what happened, he probably could have made it through that because he's learning the industry. The seller that signed a non-compete for fencing went up and started a completely different, not in fencing, but started up a new company and took 3 of the key employees with him that were the really good employees, and left the employees that weren't great, and the culture was awful. We had a relocation, and the new acquirer didn't really know the community so well. So it took him, he's grinded it out. We had an investor in that cap table. The investor brought some additional equity in, diluted his ownership a little bit, but at that time it wasn't the big point there.
Sure.
Just because more debt wasn't going to help him. More debt, like more line of credit, wasn't going to help him get through some really systematic issues there. A little more equity helped him, increased his working capital. He could go find some new employees, etc. And he's grinding it out. And he's paying us. He hasn't missed one payment. But the first year of transition was really, really difficult.
That's a great story. That we're always looking for these examples or kind of just ways to mitigate some of those seller or key person risks that you kind of touched on earlier in this call. And thinking through, in a business like fencing, where you've got more project-based revenue, especially if it's tied to kind of, new home sales, what could be kind of the next thing that goes wrong? Well, if the seller can go start a new non-competitive business, but they're able to take, you know, former employees because the skill sets are similar. Right now, you can look through that and say, are the skill sets of the team adjacent to these? How skilled are these, the people doing the work? Are these HVAC technicians that need to be licensed and really are only good at HVAC, maybe some plumbing and refrigeration work? Or is it maybe a little more generalist, things like that? So that's a really interesting story and some great examples of things to look out for.
And I just want to clarify, it wasn't actually even new home sales. It was just resales, just existing homes, resold, right? And then especially at that time when interest rates went up, home resales, went on the pause there. So that was another double whammy for him also. So he had just had a lot of things going on, and he was the kind of acquirer that he was just going to figure it out. Where you could have put another acquirer in same situation, and they might not have stuck it out.
And that's so huge too, right? Going back to kind of culture fit with the buyer. If they're kind of determined, they have a growth mindset, they're going to get through it. That can move the needle quite a bit.
Yeah, absolutely. I would say another area where we have seen, again, is around customer concentration. I'm thinking of a project where there was a 15% customer concentration. So going into it, knowing that that was maybe a risk, 15% customer, it was below our threshold to actually have to do a formal downside, but our client really took customer concentration to heart, and he structured a really smart seller note around that specific customer. That if that customer left, then the seller note would, I think it was going to be wiped out completely around that customer. So he got in there 5 months later, the customer left. And even though he could still pay back, it was fine, but it caused a major disruption, and not having that seller note around his neck while he was figuring out a lot of different things and pivoting, that really helped him a lot. So that was really good structuring around a potential transition issue.
That's a great example. The deal structure, and we always look for ways to mitigate risks like that during the diligence and execution process. And forgivable seller note is, time and time again, one of the favorite ways to do it. Or if it's not an SBA, if it's more conventional, you can use earn out, things like that.
Yeah.
So that's great.
And gave him time to kind of figure some things out, pivot a little bit, hire a few extra employees to do something a little bit different, and it's going really well. In fact, he's back looking for. I think we're going to be doing a second acquisition for him.
Very good. Well, that's a good story. Good to see that turn around.
Yeah.
Well, look, I know we're kind of running up on time here. So any kind of final remarks, anything you want to mention where, resources you guys provide for folks to learn more?
Sure. Anyone interested in self-funded search, and I offer this for your investors as well, just to get a better sense of how SBA works. I do a weekly office hours with my colleague Sarah Andrews every Wednesday. I do all things SBA. We walk through a deck for an hour. We do live Q&A. We talk about some SBA SOPs, standard operating procedures. Talk a little bit about how the process works. We do that on Wednesdays, 9 o'clock Pacific Standard. I'm happy for you to share my email, however that works. If you just want to email me for links to office hours, I can send you those. We also, on Thursday, also for our searchers, we do a deal vetting template session on Thursdays where we share an executive summary template, cash flow model, a qualitative model. Obviously, if you're in your self-funded, you don't typically have a lot of extra resources around you. So we provide deal vetting templates to hopefully have our searchers have a more thoughtful and systematic process when they're actually looking at deals. And we actually walk our searchers through those templates on our Thursday call.
That's excellent. Yeah, for both searchers and for investors that are looking to get a firmer grip on, SBA loans and kind of how they fit within the broader self-funded search ecosystem. That's great, Lisa.
Good. Happy to have investors join too, because you're really good at deals. You're good at picking them out, but the SBA overlay can get a little quirky. So happy to have you join on that.
Very good. Well, thanks so much for joining us today.
Thanks for having me. Really appreciate it.